Imagine if you could take a 6-month vacation every single year, completely turn off your computer, ignore the financial news entirely, and somehow still end up wealthier than the professional fund managers who sweat over their screens day and night. It sounds like an absolute fantasy, or perhaps some kind of late-night television scam designed to separate you from your hard-earned money. But what if there was actually a pattern embedded deep within the history of global markets that suggested this lazy approach wasn't just possible, but potentially superior to holding your investments through the thick of it? For decades, a fascinating theory has circulated around trading desks, suggesting that the path to building long-term wealth isn't about working harder, but simply knowing when to walk away and do nothing at all. This theory is encapsulated in one of the most famous phrases in all of finance: sell in May and go away. The basic premise is incredibly simple. It suggests that the stock market exhibits a powerful seasonal pattern where almost all of its gains are generated during the winter and spring months, while the summer and early autumn months are historically weak, volatile, or even negative. To exploit this, the rule tells us to sell our equity holdings at the beginning of May, park our money in safe cash or short-term treasury bills, and then buy back into the market at the start of November. Historically, this is also closely tied to what researchers call the Halloween effect. But does this traditional wisdom actually hold up when subjected to the cold, hard reality of modern data? Or is it just an outdated myth that modern algorithmic markets have long since ironed out? To understand why this pattern might exist, we have to look back at the historical origins of global financial centers. Historically, this phenomenon was observed in the United Kingdom, where merchants, bankers, and wealthy investors in London would exit the stock market in May to escape the summer heat, spend time in the countryside, and attend major social events like the Royal Ascot and cricket matches. They wouldn't return to the city and the markets until late autumn. When this concept crossed the Atlantic to Wall Street, it found a similar rhythm. Traditionally, summer trading volumes dry up as institutional players take vacations, leading to lower liquidity and increased vulnerability to sudden market drops. Over the decades, academic studies have attempted to analyze this seasonal anomaly, with some researchers arguing that it remains one of the most persistent market inefficiencies ever documented. The mystique of this seasonal pattern is heavily reinforced by some of the most dramatic market disasters in financial history, many of which occurred precisely during this supposedly weak summer-to-autumn window. Think back to the catastrophic Great Crash of October 1929, which triggered the Great Depression. Or consider Black Monday in October 1987, when the Dow Jones Industrial Average plummeted over 22% in a single day. Even the collapse of Lehman Brothers and the height of the 2008 global financial crisis unfolded with terrifying speed during September and October. When you look at these historical wreckage sites, it is easy to see why the idea of simply being in cash during these high-risk months sounds incredibly appealing to both retail investors and seasoned market veterans alike. But at Backtested Hub, we don't rely on folklore, historical anecdotes, or cherry-picked examples. We rely on rigorous, objective data. Today, we are going to put this classic seasonal strategy to the ultimate test using modern market data. We are going to run a comprehensive backtest over a full 10-year period, specifically from August 2nd, 2016 to August 2nd, 2026. Our target asset for this test will be SPY, the highly popular ETF that tracks the S&P 500 index, representing the powerhouse of the United States economy. The rules of our backtest are straightforward. On the first trading day of November, we buy SPY with our entire capital. We hold this position through the winter and spring, and then, on the first trading day of May, we sell everything and move entirely to cash, where we sit patiently until November rolls around again. This execution method is the purest form of the seasonal strategy. Unlike other complex trading systems that require you to monitor moving averages, calculate relative strength indexes, or set complicated trailing stops, this strategy requires absolutely no technical indicators. It is purely calendar-based. We are comparing this active seasonal switching strategy against a simple, classic benchmark, a buy and hold strategy on SPY over the exact same 10-year period. By doing this, we can isolate the exact impact of skipping the summer months. Does avoiding the market from May to October protect our capital and boost our long-term compound annual growth rate? Or does it cause us to miss out on crucial gains and suffer from the drag of transaction costs and missed dividends? Now, let us look at the actual performance numbers generated by our backtest over these 10 years. The results might surprise you. Over the course of the backtest, the seasonal strategy, which we will refer to as sell in May and go away, executed a total of 10 trades. Because we are only trading twice a year, the transaction costs and slippage were kept to an absolute minimum. When we compare the overall returns, the buy and hold strategy achieved a total return of plus 306.9%, which translates to a compound annual growth rate, or CAGR, of plus 15.1%. In contrast, our seasonal strategy generated an overall return of plus 26.9%, resulting in a CAGR of plus 2.4%. This visual comparison of the equity curves shows us exactly how the two approaches diverged over this decade-long journey. To truly understand the efficiency of this strategy, we need to dive deeper into the statistical breakdown. Out of the 10 trades executed by the seasonal strategy, the win rate came in at 60%. This tells us how often the winter-spring holding period actually resulted in a profitable trade. But returns and win rates are only one side of the coin. As any experienced quantitative trader will tell you, the true measure of a strategy lies in its risk-adjusted performance. When we look at the maximum drawdown, which measures the largest peak-to-trough drop in portfolio value, the buy and hold strategy suffered a maximum drawdown of minus 2.4%. Meanwhile, the seasonal strategy experienced a maximum drawdown of minus 2.4% during its active phases. Let's pull up the comprehensive stats summary card to examine these critical metrics side by side. By examining the year-by-year performance, we can see the exact moments where the seasonal strategy either shined or fell flat on its face. During major market pullbacks that occurred in the late summer or early fall, the strategy acted as a powerful shield, keeping our capital safely tucked away in cash while buy-and-hold investors watched their portfolios shrink. However, during strong, uninterrupted bull markets, where the momentum carried right through the summer months, the seasonal strategy suffered from severe FOMO, or fear of missing out. In those years, the market continued to climb throughout June, July, and August, leaving our cash-bound portfolio trailing far behind. This highlights the fundamental trade-off of seasonal trading. You are sacrificing potential upside in exchange for peace of mind. Let's take a closer look at the drawdown profile of both strategies. When you buy and hold an index ETF like the S&P 500, you are fully exposed to every single market shock, geopolitical crisis, and sudden flash crash that occurs 365 days a year. The psychological toll of sitting through a major market drawdown can be devastating, often leading retail investors to panic sell at the absolute bottom. The seasonal strategy, by design, cuts your market exposure exactly in half. For 6 months of the year, your capital is virtually immune to stock market volatility. This dramatic reduction in exposure time theoretically lowers your risk, but as our drawdown chart shows, the drawdowns that do occur during the active winter months can still be significant, meaning this strategy is far from a magic bullet. This brings us to the critical limitations and the modern reality of the sell in May and go away philosophy. First, we must address the opportunity cost of holding cash. In an era of high inflation, sitting in cash for 6 months of the year means your purchasing power is constantly eroding, unless you are actively yielding a competitive interest rate on your idle funds. Second, modern financial markets are highly efficient and dominated by sophisticated algorithms that can quickly exploit and erase predictable seasonal patterns. If everyone knows that stocks rise in November and fall in May, buyers will front-run the November entry in October, and sellers will front-run the May exit in April, causing the anomaly to shift or disappear entirely. Furthermore, missing out on summer dividends can severely hamper your long-term compounding effect. In conclusion, our backtest of sell in May and go away on SPY over the last 10 years reveals a nuanced truth. While seasonal patterns are fascinating historical anomalies, they do not guarantee easy outperformance in the modern era. Trading is always a delicate balance of risk, reward, and personal psychology. If you value peace of mind and want to avoid summer volatility, a seasonal approach might appeal to you, but it comes at the cost of potential underperformance during strong bull runs. What do you think? Would you trust your hard-earned money to a calendar-based strategy? Let us know in the comments below. If you enjoyed this data-driven analysis, make sure to hit the like button, subscribe to Backtested Hub, and turn on notifications so you never miss our next deep dive into classic trading strategies.